Okay. So, hello students. A very good morning to all of you. Students, today we are on to Money chapter 8, unit 2. Okay. We had done in our last class chapter 8, unit 1. Okay. Where we had discussed about the different theories of money demand. Today we are discussing the different concepts and theories associated with money supply. Okay. Question number 1, sir. What is money supply? Okay. Students, the first question is, what is money supply? Students, it is the total stock of money. It is the total stock of money available in the economy at any particular point of time. I repeat, it is the total stock of money available in the economy at any particular point of time. All right. C. It includes currency and certain type of bank deposits held by the public. So as long as money is floating in the economy and public can easily use it, it is a part of money supply. What your attention should be brought to is a concept of total stock of money. So money supply is a stock concept. Money supply is a stock concept, is what you need to realize here. Agreed, everyone? Agreed, sir. Students, this we had done already in the unit 1, but let's study it here because it is here again. The three major functions of money: medium, measure, and store. Money can be used to buy goods and services. That means medium of exchange. You can measure the value of any goods and service in terms of money. This is unit of account. And you can store money for your future use. That is the store of value function of money. But wait, till the previous chapter, we had been discussing about the traditional definition of money, right? Because whenever there used to be money, it used to be medium, measure, standard, or store. But here, things are changing now. In modern economies, money is defined as a set of highly liquid financial assets. Set of highly liquid financial assets whose change affect economic activity such as spending, production, and income. So here something new has come up. It is defined as a set of highly liquid financial assets whose changes. So if in the economy money supply increases, you tell me something, class. If in the economy money supply increases, that means more people are having money. If more people are having money, the demand for goods and services will rise. Hence, it might lead to inflation. To the contrary, if government reduces money supply, how so? It can do it in many ways. Government can do it in many ways. The first approach government could take is government could impose high taxes, or government can make the loans more expensive so that money supply reduces. How the government can increase or decrease money supply is a matter of third unit. What I am now discussing is what happens if they do so. So if government, let's say, increases the money supply or it reduces the money supply, either or, either or. If it reduces the money supply, what would happen? Lesser people will have money. When lesser people are having money, class, common sense dictates that there will be lesser demand for goods and services in the economy. Why? Because lesser people are having money in their hands. And when, class, lesser people are having money in their hands, naturally demand is falling. And when demand is falling, economy might face a situation like a recession. People will start losing jobs. People will start losing jobs. Why? Because businesses are unable to sell their finished goods. So, class, when businesses are unable to sell their finished goods, what will happen as a result? What will happen as a result? Obviously, obviously, so you can see the cause was fall in money supply, impact was rise in unemployment levels. This is what is exactly written in the modern definition. In modern economies, money is defined as a set of highly liquid financial assets whose changes affect economic activity such as spending, production, and income. So remember this class, whenever there is increase or reduction in the money supply, it's not going to impact one area, it's going to impact different areas, right? And that is why we are studying it under macroeconomics, not micro. Okay. One more thing I said above, if you remember, money supply refers to total stock of money available in the economy with whom? With the public. One important PYQ question, if I remember it correctly, is who is public? I mean, in the form of MCQ only they had asked. Public means everybody class. Whenever I say the word public in this chapter or in this unit, public means everyone. Except, here comes the twist. Public means everyone. Except the government. So it doesn't include the government. It doesn't include the banking system. It excludes money held by the government and the banking system. So these two are excluded from the definition of the term public. It includes everyone except who? Two are excluded here: government and the banking system. Now, why measurement of money supply is important? So, it's important for two major reasons. Why should, because all of you might ask me, sir, we have understood what is money supply. It is the stock of money available in the economy, and the change in the level of money in the economy affects production, spending, income, etc. Okay, understood, sir. But why do we need to analyze it? Why do we need to analyze money supply? Because we want to analyze monetary developments. Just for example, I told you that government increased money supply, which resulted in inflation, but it also resulted in growth and employment generation. So if this is good for the economy, some level of inflation is okay. Nobody minds some level of inflation. So if some level of inflation is happening in the economy, that's perfectly fine. But if the situation of inflation is very poor, then one needs to analyze. So if money supply grows too fast, people have more money to spend, which may increase the prices of the commodities. This is what is written here. Second point is, so first, we need to analyze monetary developments in the economy. Second, we need to study money supply to form monetary policy. Let's say the government sees that the country is facing recession. So of course, if the government sees that economy is facing recession, government will want to take some action. That is why money supply has to be studied, because it is a medicine for many diseases of the economy, right? So two things we have studied: analysis of monetary developments. Number one, to study that the medicine that we have administered. See, there are two ways I can say this. Why we need to study monetary policy. First, you have to identify the disease. To identify the disease. That is analysis of monetary development. What it does is, it studies the monetary supply and diagnoses the problem. Like, what is the economy suffering from? Is it inflation or recession? So first one was identify The disease, once the disease has been identified, you give the cure, you give the medicine. Now the government will want to decide the medicine. So in deciding the medicine also, study of monetary supply helps. Study of money supply helps. The question was, why do we need to study? Number one, to identify the disease, and number two, to decide the cure, to decide the medicine. Okay, sir, it's understandable. Very important line that's written, and I have borrowed it from ICAI material. Accurate measurement of money supply is essential for economic stability. So suppose that the economy is seeing a lot of money available, and government correctly identified that economy has lot of money, so government will reduce money supply. But let's say economy already has a lot of money, and government thinks that, oh, economy is facing problem because there is less money. It is like it is like giving more sweets to a sugar patient. The problem was high sugar. If you don't identify the correct problem, you are going to administer the wrong solution. You will give them more sugar, eat more sweets. You are feeling weak, eat more sweets. Arey Baba, he's feeling weak because he's having high sugar. You cannot give them sweets. Exactly the problem. If economy already has a lot of money, you cannot increase the money supply. For that, correct study of monetary supply is necessary. Students, after every topic, I'll wait for 1 or 2 minutes so that you can think, you can read. Okay, here is it. Here it is. Read this too. Think. Then I'll, you know, teach you the next concept. Done, okay? Done, sir. Done, done, done. Now, friends, I'll be discussing with you. Now, friends, I'll be discussing with you sources of money supply. What? Sources of money supply. Pay attention, class. Students, money supply in an economy comes from two major sources. From how many sources? Two major sources. Money supply in an economy comes from two major sources. One is the central bank, who is the primary source. Number two is the commercial bank, that is the secondary source. Sir, why is the central bank the major source? Because who prints money in the economy? Central bank, that is the RBI. RBI has the monopoly. RBI has the sole authority to print and circulate money in the economy. To print and circulate money in the economy. So number one is central bank, who is the primary source. The central bank of a country issues currency. In India, RBI issued currency notes. In India, RBI issued currency notes. Okay? Yes, sir. Currency issued by central bank is called high powered money or base money. Students, I will analyze all of these once again, but pay attention. So, what is high powered money? Currency issued by the central bank. Okay? For it, there is a formula also. currency with public, other deposit with bank, reserves. I will talk about that. But remember, characteristics of money issued are it is a legal tender because central bank has issued it with the permission of the government. It is legal tender. It is backed by government authority and it helps in creation of further money. You know why? Because only when central bank prints money, commercial banks can circulate it. Now, commercial bank, that is the secondary source of money supply. That is the secondary source. How do commercial banks create money? Through the process of lending. This is known as credit creation. It's a very interesting process and it takes around 5 to 10 minutes to explain. So listen to me very closely now. Okay. For example, legal reserve ratio is 20%. Just say, sir, now what is legal reserve ratio? Students, if RBI has 1,000 rupees, na? If RBI has 1,000 rupees, RBI is required to deposit. Actually, not RBI. I meant commercial banks. If commercial banks have 1,000 rupees, na, commercial banks are required to deposit 20% of that with RBI. So if commercial banks have 1,000 rupees, they have to deposit 20% of that. That is 200 with RBI. Who decides this rate? RBI. So suppose students, this is the RBI. It gives 1,000 rupees. It gives 1,000 rupees to commercial bank A. Commercial bank has to deposit 200 rupees back with RBI. Okay. Now, this 1,000 rupees commercial bank can have from anywhere. Now, let's start the cycle. You have understood legal reserve ratio. So if a bank, if a commercial bank has 1,000 rupees with them, they cannot use the entire 1,000 to give loans. This 1,000 can come from anywhere. Of this 1,000, 20%, suppose 20% is an example, they have to deposit with RBI. So 200 with RBI, how much are they left with? 800. This 800 can be used for granting loans by the commercial banks. Now, if I explain to you the cycle, if I explain to you all the cycle class, 800 rupees commercial bank A gave loan to somebody, to somebody. Okay. Let's say Mr. Raj. Mr. Raj deposits this money in his bank, 800 rupees. Now, the name of the bank is Bank B. You all know, can Bank B use this entire money to give loan to somebody? No. Again, 20% they have to keep aside for RBI as a reserve. So 20% of 800 is 160. So this 640 can be used by commercial banks to grant loans. Out of the total money, 20% they have to deposit with RBI. So 640 is the loan granted to Mr. Shyam. Mr. Shyam gets rupees 640. He deposits it in his bank account C with Bank C. Bank C receives 640. But do you think Bank C can grant entire 640? No. Bank C can only grant 20% to RBI. That is 128 approximately. And remaining money can be used to give loan to public. Now you look at this cycle. How much was the initial deposit with Bank A? 1,000 rupees. Initial deposit was 1,000 rupees with Bank A. But look at the loan circulation. Mr. Raj got 800 loan. Who is this? Mr. Shyam. Mr. Shyam got 640 loan. Okay. Then 512. Let's say Mr. Dinesh received. Mr. Dinesh received 512 loan. So this cycle of 80%, 80%, 80% is going to continue till the amount is so small that it cannot be granted to anybody in the form of loans. This cycle that I just explained is called the process of credit creation by commercial banks. So if institute asks you a very important question, who creates credit in the economy? That is, who circulates loan in the economy? To creates credit, commercial bank. But if institute asks who controls credit in the economy, like what is the interest rate, etc., etc., it is the RBI, the central bank. It is the RBI, that is the central bank. It is the RBI, the central bank. Got it, everyone? Got it, sir. Got it. Now, evolution of forms of money. Evolution of forms of money. Number one is commodity money. Students, money has evolved through different stages. First was commodity money. First was commodity money. Goods like salt, cattle, or grains used as money. Earlier, you used to see barter system, right? So, in exchange of goods, you used to get goods or services. So, let's say I have 10 kgs of rice. I will give you that. You give me, let's say, 5 kgs of some pulses or something. Something like that. With the change in times class, there came metallic money. That is gold and silver coins. The problem with gold and silver coins, do you know, class? What is the problem? Students, the problem is, pay attention. The problem is, if I need to buy something worth rupees 50 rupees, can a gold coin do that? Gold coin is worth much more. So the problem was with divisibility. So metallic money gone. So metallic money gone. Then there used to be something called paper money. Paper money is what you see today. 50 rupees note, 20 rupees note, 500 rupee note, what not and what not. So these are currency notes issued by the government. That is paper money. That is paper money. Once paper money stopped, class, then came digital money that you see today. We are in the world of digital payments, right? We are in the world of digital payments. GPay, Paytm, UPI, the entire UPI scheme. And do you know there is something called Bitcoin? Do you know it, students? Bitcoin. So you should research it. It is not legal by the government. If you don't know it, then you lack general knowledge. You should research it. Okay. But the point is, Bitcoin has been declared, I would not say illegal, but it is not legal. Government does not accept Bitcoins as legal tender. But government is planning, RBI is planning to bring its own digital currency. Bitcoin is a digital currency. For now, I can only say this. But now, RBI is introducing its own digital currency known as CBDC, Central Bank Digital Currency, known as Central Bank Digital Currency, CBDC, Central Bank Digital Currency. See, this is what I said. India has introduced the digital rupee as a digital form of sovereign currency issued by RBI. And in notes, I have written for you all, class, cryptocurrencies like Bitcoin are not legally recognized as currency in India and therefore are not included in money supply. And therefore are not included in money supply. Are not included in money supply. Got it? Now, class, let me elaborate for you things in details. Let's see. Let's see, everyone. Money supply refers to the total stock of money available in the economy at a given point of time. Did I not say this? Yes, you did, sir. Now, how many measures of money supply are there? There are four measures of money supply: M1, M2, M3, and M4. Very important. Very important. M1, M2, M3, and M4. Class, please remember this. M1 is called narrow money. M1 is called narrow money. And do you know what? Do you know what? M1 is narrow money and M3 is broad money. M3 is broad money. This is an important PYQ question. There have been years, students, where institute gave all the data. Today we will practice that. Institute gave different numbers and they asked to compute M1, M3, M2S like this. So let me have a go at it one by one. M1, that is narrow money. Class, it is currency with the public. Currency with the public plus demand deposit with the entire banking system. Demand deposits with the entire banking system. Now the question is, what is demand deposits? Sir, as the name suggests, these are deposits with the commercial banks of the public, withdrawable on demand. Withdrawable on demand. So whenever I say my commercial bank that, okay, look, I have deposited so much money in your account, so I need that for some XYZ reason. They will have to return me. They will have to return me that money. It is also known as CASA deposits. What is it also known as? It is also known as CASA deposits. CASA. CASA. It is also known as CASA deposits. CASA is current account and savings account. CASA is current account and savings account. So therefore the name CASA deposits, current account and savings account deposits. And of course you have other deposits with RBI. This is M1 referred to as narrow money. Then you have M2 class. What is M2? M2 is M1 that you already have M1 plus savings deposit with post office savings bank. Savings deposit with post office savings. Okay. So M2 is M1 plus savings deposit with post office savings bank. Then you come to M3 class. What is M3? M3 is, dear students, M1 plus time deposit with banks. Sir, what does time deposit include? FD and RD. Deposits with banks for a longer period of time. Time deposits. Okay. Fixed deposit, money you hold in the fixed deposit, money you hold in the recurring deposit. So net time deposit with bank, FD, RD. FD and RD. And finally, what is M4, dear students? What is M4? You are right. It is M3. It is M3. M3 plus total deposit with post office savings organization. Total deposit with post office savings organization, excluding national savings certificate. So M2, acha, I will give you a trick also. Remember, even numbers have post office. Even numbers have post office. Yes or no? You see M2, savings deposit with post office. M4, total deposit with post office. Next. Class, the next thing is, you remember, I had told you something about high powered money. Remember, first of all, before I say the calculation, we have discussed it already. I am just summing it up. There are two main components of money supply: high powered money and credit money. High powered money is the money RBI issues. It is also called reserve money, central bank money, base money, or monetary base. Wow, so many names. So it is also called reserve money. Class, it is also called reserve money, central bank money, or monetary base. Okay. Now, what does it include? It includes the currency that is circulating in the economy, the banker's deposit with RBI. Banker's deposit, do you understand? Banks also have to maintain certain deposits with RBI. Yes or no? That is banker's deposit with RBI. That is banker's deposit with RBI. And eventually, dear students, other deposits with RBI. Other deposits with RBI. So, dear, high powered money includes currency in circulation, banker's deposit with RBI, and other deposits with the RBI. Then, now class, credit money. What is credit money? As I had told you, money created through lending, through loans. Who creates this? Commercial banks. Created by commercial banks through lending and deposit creation. Understood? Right, sir? Understood. Pay attention, everybody. There are certain new monetary aggregates that RBI had introduced. In addition to M1, M2, M3, M4. Chances are very less this institute asks from here, but I am just discussing it for the sake of it. Okay. First is reserve money. You have forgotten what is reserve money? High powered money or monetary base. It is equal to currency in circulation. It is equal to currency in circulation plus bankers deposit with RBI plus other deposits with RBI. That we have done. Currency in circulation, banker deposit, other deposits. Now, NM1, new monetary aggregate 1. Currency with public, demand deposit with banking system plus other deposits with RBI. Demand deposits with banking system plus other deposits with RBI. This is M1 only, labeled as NM1. Then NM2 is NM1 plus short-term deposits of residents. That is deposits that people have done for up to 1 year. Then you have NM3. This is NM2 plus long-term deposits of residents. L1 is NM3 plus all deposit with post office savings bank. And finally, L2 is L1 plus term deposits and certificate of deposits, etc. You did not learn all this I don't think they will ask, but reserve money is important out of these. Coming back to the notes that I was discussing from, I will refer both whenever needed. So here it is. High powered money or monetary base, we have discussed it. Very, very important class. Very important. Money multiplier. Money multiplier. Money multiplier. Students, total money supply in the economy. Total money supply in the economy is represented by capital M. That is equal to money multiplier by monetary base. You understand what is monetary base now? Don't ask me, right? Sir, we know monetary base is high powered money. You are going to say this, right? Yes, exactly. It is high powered money that we are talking of. So money supply is money multiplier into money base. That is high powered money. Now class, money multiplier, how is it calculated? It is money supply divided by monetary base. It is money supply divided by monetary base. If money base increases by 100 crore and supply increases by 500 crore, so class, how much times has it increased by 5? It has indeed increased by 5 times. It has certainly increased by 5 times class. So each 1 rupee of base money creates 5 rupee of money supply. Understood, sir. Understood, sir. I will come to this formula, but first formula that you have understood is you should practice it again with me. Monetary supply is money multiplier into monetary base. This is the first formula. Second way to compute money multiplier, that is small m. See, now small m, how to compute small m can be detailed in 3 ways. Depends on the information available at our disposal. जितना इंफॉर्मेशन हमारे पास होगा उस हिसाब से हम लोग कर सकेंगे. For example, students, if they give us monetary supply and monetary base, in that scenario, money multiplier is equal to monetary supply by monetary base. This is formula number 1. Second formula, to compute M, 1 by legal reserve ratio. If you had economics in your 11-12, class 11-12, you would have done this formula. Isn't it? Do you remember such questions? That time it used to be called credit multiplier. I'll give you an example. Today we were discussing legal reserve ratio is how much? 20%. So how much money multiplier is? That money will become how many times? So 1 by 20%. 5 times. So you remember the initial deposit of 1000 will become 5000. 5 times. Understood both? The one that demands the greatest amount of discussion is the third one. Money multiplier equal to 1 plus C by R plus E plus C. 1 plus C by R plus E plus C. Sir, आप बताएं, what is it exactly? You tell us, sir. You guide us, sir. Certainly. See, I have told you already, it's 1 plus C by R plus E plus C. All right. I have already told you this. Now let me take you to the detailings of it. Let me take you to the deeper end of this discussion. Let's see. Number one, pay attention here. Three things are there. Number one is high powered money. H. Yes, high powered money. High powered money is nothing but the monetary base. Who controls the monetary base? Central bank. Then you remember I told you 1 plus C by R plus E plus C. Then is R, reserve ratio. Reserve ratio. Reserve ratio is class determined by who? Commercial banks and central bank regulations both. Reserve ratio and excess ratio. Let me explain it to you, class. Reserve ratio, for example, let's say RBI fix that everybody has to deposit 20%. That is okay. But commercial banks may keep some excess also. Let's say 25%. RBI prescribes that minimum 20% they have to keep with RBI. Above that, they can also keep. They means the commercial banks. And finally, we have what? Currency deposit ratio. Finally, we have what, bolo? Currency deposit ratio. It is the behavior of the public. It is the behavior of the public. In currency deposit ratio, what is the behavior? See, currency deposit, you understand currency by total deposits. It means that suppose I deposit 1,000 in the bank. I am a person who is earning money. I deposit 1,000 in a bank. Now, dear students, if I deposit 1,000 in the bank, some money I need to keep as currency as well. Let's say I am keeping 300 in the currency form. So my currency deposit ratio is 0.3. That means out of every 10 rupee I deposit in my bank, in exchange of that 3 rupees I keep with myself in the form of a currency. That is the currency deposit ratio. Who controls that? I, public. So you see, three components controlled by three different economic agents. 1 plus C by R plus E plus C. C is currency deposit ratio. Behavior of the public. R is the required ratio set by the RBI. And E is the excess reserve that commercial banks by their own will decide to maintain. In my example, when I said, about this 20% thing, that 20%, was the minimum thing. If somebody wants to maintain extra 5%, any commercial bank, they are welcome to do that. Sir, understood. Understood? Right, sir. Clear. Before I move forward now, let me take you to a question or two before we can proceed. Okay, and one more thing before I start solving this question, one more thing I wanted your attention, kind attention towards is that you see, monetary supply, we have already discussed this, you don't need to write it again, is money multiplier into monetary base. You need to understand one thing, class. It means if money multiplier increases, money supply increases. Yes or no? Similarly, if monetary base increases, then also money supply increases. So money supply has direct relationship both with money multiplier and with monetary base. with both. Agreed? Right. But what about the different reserves, sir? What about the different reserves, sir? You all remember M is 1 plus C by R plus E plus C. M is the multiplier. So all these three reserves have inverse relation. All these three reserves have inverse relation. Meaning, if the required reserve ratio increases, if the required reserve ratio increases, R increases. Okay? Class, if R increases, then money multiplier goes down. Okay, because it is inversely related. And if money multiplier goes down, money supply also goes down. Relation number one. That is why I said, in short, everyone has inverse relation. Every ratio has inverse relationship with the money multiplier. You should write it down, class. If R increases, money multiplier goes down, so money supply also goes down. Relation number two, same with C. C increases, that is people decide to hold more in the form of currency. Naturally, the money with the banks will go down. So if the money is low, can they grant more loans? Can there be more money supply? No. So if currency deposit increases, multiplier goes down. So monetary supply also goes down. Correct. Correct, friends. And friends, the third thing is the with your E. If E increases, again, dear students, M falls, and therefore monetary supply also goes down. I hope the discussion has been pretty clear to every friend. Understood, sir. Finally, I can, talk about the question that I was about to. We will revise all this once I am able to solve some questions with you. You see, in Gladys land is some hypothetical country. Okay. R is required reserve ratio is how much? 0.1. R is how much? Tell me, class. 0.1. Now, dear students, currency is 400 billion and deposit is 800 billion. So class, small c we can find out currency deposit ratio, currency by deposits, currency by deposits. Certainly, sir, we can find it out. That is 400 billion by 800 billion. That's 0.5, class. That's 0.5, everyone. Agreed? Right, sir, agreed. So, sir, R is pretty clear to all of us. C, you have already told 400 by 800, 0.5. C, then excess reserve is 0.8 billion. 0.8 billion. So students, you need to understand excess reserve is 0.8 billion. 0.8 billion is 800 million. 0.8 billion is 800 million. Now what I am saying is, everyone, E, excess reserves is 800 million by total deposits. So 800 million or 0.8 billion, whatever you want to write, whatever, 0.8 billion by total deposits was 800 billion. So you get 0.001. Yes or no? Yes or no? Always, acha, denominator is always total deposits. So class, you see, you have E, you have C, and you have R. None of them is in percentages, mind you. None of the three is in percentage. Okay. So now money multiplier is 1 plus C by R plus E plus C. So 1 plus currency deposit ratio, is 0.5 and R plus E plus C. R is 0.1, E is 0.001. plus 0.5. That you have understood. So how much are you getting, class? 2.5. How much are you getting, class? Let's say 2.5. So it means a 1 rupee increase in monetary base leads to a 2.5 increase in money multiplier, leads to a 2.5 increase in money multiplier. If they ask you simple deposit multiplier, do you understand simple deposit multiplier? Your class 11, 12 formula. 1 by required reserve ratio. That's 1 by 0.1. That's 10 times. Sir, but in exam, if they give, what we will compute? Obviously, the bigger one. If they want to know the simple formula, they will give you. State the simple formula. Got it? Got it, sir. Got it. It's clear to us. So let's sum it up a bit before I can proceed further, or before I try to proceed further. Here it go, class. It goes like total supply of money is determined by the joint behavior. Whose behavior? Joint behavior of the central bank, joint behavior of the central bank, commercial banks, and the public. Joint behavior of the central bank, commercial bank, and the public. Okay. So class, what happens is central banks sets the required reserve ratio. Central bank sets the required reserve ratio. Okay, done. Central bank has set the required reserve ratio, small r. Central bank controls the high powered money, that is the monetary base, MB, and controls the high powered money. Now, commercial banks, they decide excess that they want to maintain. Didn't I explain this? Didn't I say this? Tell me. And what does the public do, class? Public decides currency ratio. Public decides currency ratio, whether you want to hold currency versus deposits. So money supply is equal to money multiplier into monetary base. Now here it is. Here it is. Small m equal to 1 plus c by r plus e plus c. Right? Yes, sir. Agreed. Yes, sir. Agreed. Class, if I talk to you about factors affecting money multiplier, pay attention, class. If I talk to you about factors affecting money multiplier, here it goes. First one is the required reserve ratio. First one is the what? Tell me. Required reserve ratio. If the required reserve ratio falls, that means commercial bank will be able to give more money in the form of loans. That means commercial bank is able to give more money in the form of loans. So larger will be the money multiplier and therefore the money supply. I have already, haven't I already told that all the three reserves R, E and C have what relation with the multiplier? Inverse relation with the multiplier. So all the three R, E and C have what relation with the multiplier? Inverse with M. You have already written already. If they ask you for a simple deposit multiplier, class, pay attention in the exam. If they say money multiplier, use this. But if they use the term credit multiplier, or if they use the term deposit multiplier, then only use the simple formula. If they use the term credit multiplier or deposit multiplier, class, then use the simplest of all. 1 by required reserve ratio. I have already spoken that to you, right? Coming back to our discussion. Coming back to our discussion. Here it is. Okay. Students, see some question. Okay. Go ahead, class. Pay attention. Calculate narrow money. Calculate narrow money from the following data. From the following data. Narrow money. See this. By the way, do you want to hear something good? This is a PYQ. We imagine this was in the institute question and then it came in the past paper also. It doesn't mean that only it comes from here, but it also shows that how important ICAI study module is. Let's solve it, class. Let's solve it, class. Calculate narrow money from the following data. First, let's revise the formula. Okay. Currency with the public, demand deposits with bank, other deposits with RBI. Now, currency with public is 90,000. Demand deposits is 2 lakh and the other deposits is 2 lakh 80,000. So for now, what I have got is 480 plus 90,000. 480,000 plus 90,000. That's how much thousands? 570,000. Here it goes, 570,000. 570,000. Now, solve the second question, class. If you can, please solve the second one. Compute credit multiplier if required reserve ratio is 10% and 12.5% for every 1 lakh deposited in the banking system. Please do that. Please do this one on your own. Remember the term they have used. Credit multiplier. Hint is here. So here it goes. First of all, for 10%. 1 by 10% is 10, class. And 1 by 12.5% would be 8. So what will be the total credit money created by the banking system in each case? So 10 times. Initial deposit is how much? 1 lakh. So 10 times of 1 lakh will become 10 lakh in the case 1. And in the case 2, it will become 8 times of 10 lakh. That's 1 lakh. That is 8 lakhs. So here it is. 10 lakh and 8 lakh. 8 lakhs. Again a PYQ. This question also came. Obviously with some other numbers. Calculate currency with public. Calculate currency with public. Try it out, everybody. Try it out. So here it goes. See, one thing I know many of you will make mistake. It's not your fault. I'll explain that. Whenever they ask class to calculate currency with the public, remember when you proceed, when you start the discussion, you always start with what? Notes in circulation. You always start with what? Notes in circulation. So start from notes in circulation plus rupee coin plus moil coin. And some portion of it is with who? With the bank. And tell me something. Is bank included in the definition of public? No. So we will deduct that. So we will deduct that. Because some portion is with bank and we don't include bank. Please solve it, class. The sum of first three and reduce the last one. So whenever you have cash on hand with bank and you need to find the currency with public, remember bank is not included. You remove them. What is the next question, class? Calculate M2 from the following data. Try it out, everybody. M2 from the following data. So students, you remember M2, it is post office will be included even number. Now it will include M1. What is M1? Currency with public, demand deposit with banks, other deposits with RBI, plus post office savings deposit with obviously post office, the name itself says. So everyone, everyone, currency with public includes all these three. Post office savings bank will be included. Other deposits with RBI, demand deposit with bank is here this much. Here it goes. Deposit money of the public. Deposit money with banks, nahi, deposit money of the public. So here it goes. M1 plus post office savings deposits, where M1 is notes in circulation plus rupee coin plus small coin minus cash with banks. If you have cash with banks, here it is. You deduct that plus deposit money of the public. Public deposit money is this. Deposit money of the public. And obviously, then you add post office savings, right? Because if you all remember the formula, class, here it goes. M1 was currency with public plus demand deposits with the banking system plus other deposits with the RBI. Other deposits with the RBI. So other deposits with RBI is here. Okay. Coming back, everybody, coming back to another question. If the required reserve ratio is 10%, currency in circulation is 400 billions, and demand deposits are 1000 billions, excess reserves 1 billion, find the value of money multiplier. M is 1 plus C by R plus E plus C. Class, if required reserve ratio is 10%, 10% is 0.1. Now, excess reserves, that is small e. 1 by total deposits. 1 by total deposits. You remember that, right? So here it is 1 by total deposits. Absolutely perfect. I am talking about E, okay? So 1 by total deposits is 1000 billion. 1000 billion. So 1 by 1000, 0.001. Excess reserve. This was excess reserve. Now R is also what we have. See, currency in circulation 400 billion. We have done a question like this, isn't it? Currency deposit ratio by deposits, that is 1000 billion. That gives you 0.4, everyone. So what is M is equals to 1 plus C is 0.4 by R plus E plus C. R is 0.1, E is 0.001, C is 0.4. 1.4 by 0.501. 0.501. Divide it class and you find your answer. 1.4 by 0.501. You divide it and you find your answer. So it's 2.79, right? It's 2.79 is what people are saying. Correct answer. Okay. Having done this much class, we can now proceed further. We can now proceed further and go on to what, sir? Solving some MCQs, if you may. I will solve the institute also and this one also that has been designed by me. Fatafat, let's start the first question, okay? Try it out, everyone. Which of the following is included in M1? Their question is not included nahi hai. It's included hai. So M1 formula is, all of us know, other deposits with RBI, demand deposit with banking system, and currency with the public. So currency with the public is what I see here, because post office comes in this one, even numbers. So time deposit is not included, only it is in M3, or it will come later on, not here. So correct answer is this. Yes. Reserve money is also known as a good one. Reserve money is also known as, come on. So students, as you all can already see, we have base money, we have high powered money, we have central bank money, and we have all of the above. The correct answer to this would be all of the above. Isn't it, class? Right, sir? All of the above is the correct answer. The ratio of currency held by public to demand deposits is called what? The ratio of currency by public to demand deposits is called what? What is it called? See, currency to by public to demand deposit is called currency ratio. Isn't it, students? We discussed it today, right? Currency deposit ratio or currency ratio. Absolutely perfect, sir. Moving on. Now, which tool is used to absorb liquidity? You don't need to tell me now because it is a part of monetary policy. If time permits today, I will start unit 3 as well. Don't worry. So nothing to worry about here. Okay. Forget this. We have not done it yet. Yes, this one. Money multiplier formula, friends. So class, money multiplier is 1 plus C by REC. Yes. If CRR is 10%, what is credit multiplier now? Students, credit multiplier is 1 by CRR. 1 by 10%. That is how much? Tell me. 10 times. Good question. 12th one, class. Money supply is equal to what? So students, if you all remembered it, and if you all have practiced it, today only we have done it, money multiplier into monetary base. Absolutely correct. Good one. This is good one. Currency of, sorry, component of money supply. So a component of money supply, which is not influenced by RBI directly, not influenced by RBI directly. I'm waiting for a minute or two. Not monitored, not influenced. Tell me which one, class. Agreed. So students, the component of money supply, which is not influenced by RBI directly, see, they are giving cash reserve ratio, SLR, public's cash holding repo rate. See, how much public is holding as cash, how RBI can decide. That is your decision, public decision. Yes, very important question and a very good one actually. Which of the following increases money supply in the economy? Think and answer. Everybody think and answer. So here it goes, class. Which of the following increases money supply? See, CRR inverse relation hai. It will decrease money supply. SLR same thing. But wait, if government starts purchasing securities by RBI, purchase of government securities by RBI, what will happen? When government purchases in return and therefore increasing money supply. What is the consequence of high money multiplier? So students, if there is a high money multiplier, what do we see? High inflation risk, tight liquidity, increase in SLR or decline in GDP. What do you see, class? High money multiplier. So if there is a high money multiplier, class, there is a high inflation risk. You know why? Because they have tried to trick you. They wanted you to think high money multiplier means high money supply. And if there is high amount of money supply, more people have money, hence more inflation. Majority students are unable to connect high money multiplier means high money supply. What happens if currency deposit ratio, you all know currency deposit ratio with the notation C, isn't it? You all know it with the notation C. So what happens if there is a decrease in C? If there is a decrease in C, yes. So a decrease in C increase money multiplier. So 20A is the correct answer, class. This has been the questions that I had framed. Some institute questions also we should practice so that everything is well prepared. Let's see. Let's see, class. We will take time, huh? There is no hurry. Reserve money is also known as what? Students, if you know, we have done this one already, all of the above. It's known as central bank money, base money, high powered money, everything. Second one seems interesting. It will, why institute gives such questions, like the second one, they want to consume your time. Read it out. Money is deemed as something held by the public, and therefore only currency held by public is included in money supply. See, what they are asking us is to choose the correct, and therefore only currency held by the public. See, it is not that money is deemed as something held by the public and therefore interbank deposits are included in money supply. No, they are not. Since interbank deposits are not held by public, therefore interbank deposits are excluded from the measure of money supply. This is correct. This is correct. Achha, one more thing, class. Let me take you to the institute initial pages. I will show you one thing. I want you to read one thing actually. Yes, here it is. The term public is defined to include all economic units except the producers of money, right? So everything is included in public except the producers of money. So everybody, money is deemed as something held by public, and therefore only currency held by public is included in money supply, right? The problem is this thing is deemed as something held by the public. See, it can be held by anyone. Otherwise, it would have been correct. So C is correct. C is correct. That interbank deposits are not included in money supply. Reserve bank, reserve money is composed of, reserve money is composed of what? Reserve money means monetary base, currency in circulation plus bankers deposit and other deposits with RBI. See, currency in circulation, bankers deposit with RBI and other deposits with RBI. M1 is the sum of, dear students, M1 is the sum of currency and coin with public people, demand deposits of bank, other deposits of RBI. Yes, CASA deposits are included here. Yes or no, dears? So M1 is here. Correct. A is correct. Fifth point. Under the minimum reserve system, yes, you all know what minimum reserve system is. कि आपको अपने total deposits का, all of you, out of your total deposits, have to deposit some money with the public. You, all of you means all of you banks, right? So under the minimum central reserve system, central bank is empowered to issue currency to any extent by keeping only a certain minimum reserve of gold and foreign securities. Yes, the central bank will keep their reserves and then issue money. Sixth one is the easiest. Primary source of money supply. Primary source of money supply in all countries is Primary source of money supply class in all countries is central bank of that respective country. So in sixth one, the correct answer would be central bank of that country. Seventh one, supply of money in an economy depends on what? Supply of money in an economy depends on decision of central bank and supply responses of the commercial banking system. Because you have studied it, two primary multiple money suppliers are these two, the central bank and the commercial bank. You remember, central bank creates money through high powered money and commercial bank create money through credit multiplier. So 7B apparently is correct. Eighth one. I repeat, students, I have been discussing it in the previous economics classes as well. To do well in economics is not a big game. You just need to keep 2 to 3 things in mind. Game number one, you should be attending classes and making your working notes, working notes or handwritten notes. Why? Because when you attend the class, you would know you understand everything in that class. But when you write it in your own language, it becomes a good reference point for later on. Because you will be appearing for the exam, let's say 1 month from now, 2 months from now, whatever the day may be. It would become very beneficial. First point. Second point, you should solve MCQs with the teacher. Like I am helping you. Almost in every class, we are doing 30 to 40 MCQs, if the number is correct. So you should be focused. If some MCQ you have done wrong, you should particularly keep that in mind. Third point, ICAI module has to be read twice or thrice. If you're not doing that, I'm talking about economics right now, your preparation is incomplete. And if you do all these three, I challenge you to bring less than 70. You would not be able to bring less than 70 in this paper. Question number 8. Banks in the country are required to maintain deposits with the central bank, right? Why? Think carefully and answer. See, banks are required to maintain deposits with central bank to provide necessary reserve for functioning of central bank. Do you really think central bank needs their money to meet the demand of money by the banking system? No, to meet the central bank reserve requirements, to meet settlement obligations. Because central bank has prescribed the requirement, you have to follow that. Ninth one is the best question I have seen in today's class. Read the ninth one class. Read the ninth one class. If the behavior of public and commercial banks is constant. So if the behavior of the public and commercial bank is constant, pay attention, behavior of the public means currency deposit ratio is constant and commercial banks is constant, means excess reserve ratio is also constant. Now their question is what? Total supply of money will vary directly with the supply of high powered money issued by by central bank. Yes, because money supply is what? Money multiplier into monetary base. Who controls the monetary base? The central bank. अगर पब्लिक का बिहेवियर और कमर्शियल बैंक्स का बिहेवियर, if you, both of their behaviors is constant, then who is determining the money supply? The central bank. What does central bank control? high powered money. So how come you are unable to say this? This is the correct answer. I can read others also, but let's see. What does it say? The total supply of nominal money in the economy will vary directly with the rate of interest. Total supply will vary directly with the rate of interest and inversely with reserve money. Wrong. Because total supply increases when monetary base increases. There is a direct relation between the two. B is wrong. Again wrong. So here it is. Under the fractional reserve system. Very easy. What is fractional reserve system here, sir? We did not understand. Students, right now I taught you money supply is what? M into monetary base. M into monetary base. So think carefully. Increasing function means direct relation. If M increases, I had drawn this also like this. This increases. This increases. This increases. So both are moving in the same direction. And that is fractional reserve system. It is an increasing function. This direct relation is an increasing function. A is correct, therefore. See, it's written is an increasing function. Means is directly related to. Money supply is an increasing function means it is directly related to reserve money and money multiplier. Reserve money and money multiplier. Next, number 11th. Class, read this one and then answer. Number 11th. I'll wait for 1 minute or 2 minutes before I answer. Everyone, the money multiplier and the money supply are. Class, it's very easy. First of all, money multiplier and money supply both move in the same direction. So if it increases, this increases, vice versa. Not much worried about that. But wait, wait. They are inversely related to excess reserve ratio. You know why? Because we did it today only. First of all, I'll mark and then I'll say when E falls, MS rises. Yes, we have discussed it. Correct? Right, sir. 12th and the 13th one. Class, think carefully before answering. 12th and the 13th one. Currency ratio represents whose behavior? See, we have already discussed. 1 plus, I had drawn this. I'll do it again for you all. R plus E plus C. C is currency deposit, behavior of the public. R is decision of the RBI. E is decision of the commercial bank. C is obviously behavior of the public. So currency represents behavior of the public. What is the formula? Currency by total deposits. It is the ratio of currency held by the public to the total deposits that they hold. Agreed, sir. Agreed, sir. 13th one. Let's go ahead, class. 13th one. The size of money multiplier is determined by. The size of money multiplier is determined by 1 plus C by R plus E plus C. Yes. So money multiplier is currency ratio. Yes. Reserve ratio. Yes. All of these are perfect. All of this together determine that. So definitely it's okay. I hope students now you are getting the control of this. topic, right? Question number 14. Let's see. Dash tells us how much new money will be created by the banking system for a given increase in high powered money. For a given increase in high powered money. Dash tells us how much new money will be created by the banking system for a given increase in the high powered money. How much money will be created for a given increase in high powered money. So of course, students, it is credit multiplier. It is the multiplier. Okay. 15th one. Yes. If you have paid attention, you will answer the 15th one correctly, class. If you have been paying attention, you will certainly do it correctly. The money multiplier will be large. Money multiplier, okay, will be large for low currency ratio. Yes. C falls, M rises. R falls, M rises. E falls, M rises. Perfect. Hai? It's perfect. So C is correct. 16. 16th. The ratio that relates the change in money supply by monetary base. Students, you have already known this ratio. It's the money multiplier. How you have studied it is MS equals to M into MB. What institute did was basically institute sent it this side, trying to confuse you, and that was it. That was it. So MB was sent this side, and therefore we know that the ratio that relates the change in money supply to a given change in monetary base is what the ratio is called. What? Money multiplier. Money multiplier. Seventeenth one. For a given level of monetary base. 17th one. For a given level of monetary base, an increase in required reserve ratio will denote. So let's see. Money. Acha. Again the same thing. M into MB. Okay. For a given level of monetary base. Class, pay attention. So monetary base remains the same. Increase in the required reserve ratio. So if reserve ratio rises, small m will fall. And if small m falls, MS will also fall. So the correct answer is a decrease in money supply. A decrease in money supply. Because when R rises, small m falls. Small m falls, so MS will fall. What's wrong there? Perfect, sir. Sir, we certainly do understand this. 18th one. 18th one. For a given level of monetary base. So monetary base remains the same. An increase in ratio, current ratio. See, C rises. C rises. So money multiplier falls. So see, here is decrease. Here is also decrease. D cannot be the answer. B cannot be the answer. Now let's further study. And money supply too. Okay, if money multiplier falls, money supply will also fall. So both decrease. C is the correct answer. You see how much emphasis institute has laid down on the relation between these three. 19th one and the last one before we move to unit 3 class. At least you start unit 3. All right. If commercial banks reduce their holdings of excess reserves, so it means small e falls. If small e falls, what happens? Money supply increases. Got it, everyone? Monetary supply increases. So finally, class, I would like to take the opportunity to start unit 3 with you all. And okay, and some, before I start with unit 3, some conclusions I had noted. I want to read it with you. Okay. Effect of government expenditure on money supply. I wanted to discuss that with you before I start. Okay. See, government incurs expenditure. RBI provides loans under ways and means advances. Excess reserves are generated in banks. And all of these increase money supply. All of this increase money supply. Coming back now to unit 3. I'll definitely start with unit 3 now. Hold on, class. Here it is. Money supply we have done. So unit 3. What is the name of sir? Chapter 8. Chapter 8, correct? Unit 3. What's the name, sir? Friends, friends, the name is monetary policy. What's the name? Monetary policy. What is it? Monetary policy, everything, sir. Please, could you elaborate it for us? Sure. My dear friends, monetary policy. My dear friends, it is the use of instruments by who? By who? By the RBI. By who? By the RBI to control money, interest rates, inflation, and liquidity to achieve price stability and economic growth. To achieve price stability and economic growth. So here it is. It is the use of instruments by who? RBI. And what does RBI do? It controls money, interest rates, inflation, and liquidity to achieve the goals of price stability and economic growth. Number 2. Got it? So, class, I have elaborated it for you. It is the use of instruments by the RBI to control money, interest rate, inflation, and liquidity to achieve price stability and economic growth. So, what all are used? Money control, right? Interest rates, inflation, and liquidity. So, 4 things are controlled with 2 objectives: price stability and economic growth. See, time and again, we have been referring to monetary policy, monetary policy, monetary policy. Finally, we are here. Finally, we are here. So, dear students, think carefully before answering. See, there are how many policy decisions that the government can take to influence the money floating in the economy? There are 2 decisions that the government can possibly take. One is in the form of fiscal policy, that is taxation. We discussed it, yes or no? Where did we discuss it, class? We discussed it in the earlier chapter. Unit 4, fiscal policy. The one dealing with public finance. Here, we are discussing in the unit 3, monetary policy. Again, here, Government will again increase or reduce money supply here. But here through whom? Through RBI. By causing fluctuation in interest rates to deal with situations like inflation and recession. How so? We will discuss that. Before I discuss that, remember there are some objectives of monetary policy under the RBI Act 1934. All of us need to remember objectives of monetary policy under the RBI Act 1934. Do you know about RBI Act 1934? See, whenever government wants any institution with some special powers, government sets up a separate law for them. Government in the parliament passes a separate law for them. RBI Act 1934 was passed as a means to empowering RBI with certain decisions, to make certain decisions rather. What are the objectives of RBI under the Monetary Policy Act? Price stability and growth. Price stability. In terms of monetary policy, the first goal is price stability, ensuring credit flows to productive sectors. Sectors that bring money into the economy, money reaches them. To encourage investment, because you see, India is a developing economy. Class, try to understand. India is a developing economy. In a developing economy, we maintain deficit budget. That is, we want people to spend more so that the growth rate increases. When I say when we want people to spend more, I mean both. I mean both. I will want the household sector to spend more. I will want the household sector to spend more. I will want the firms to spend more. I want both of them to spend more. You know why? You know why? Because if the household sector spends more, अगर household sector ज्यादा खर्चे करता है, it's good. If the household sector spends more, it's good. Businesses will do well. And if the business sector spends more, it means they are investing more. So the objective here is to encourage investment through moderate interest rates. Sir, how can interest rate affect investment? In short, if loans are available to the public at low rates of interest, if loans are available to the public at low rates of interest, think carefully. If loans are available to the public at lesser rates of interest, naturally, they will be in a position to borrow money from the banks. And if they borrow money from the banks, I'm talking about the private sector businesses, they would undertake investment. That's what you need, right? That's what you need. Encourages investment through moderate interest rates. Got it, sir. Next, finally, to develop government securities market, and maintain financial and exchange rate stability. To maintain financial and exchange rate stability. To maintain financial and exchange rate stability. Here it is interesting. Financial and exchange rate stability. Financial stability means there is no too high inflation or there is no bigger problem of recession or depression. And exchange rate stability means, let's say $1. About exchange rate, we have chapter number 9. Dealing with entirely exchange rate only. Whatever it is, say $1 is 80 or $1 is, let's say, rupees 94. Some fluctuations will always occur because dollar is always in greater demand than rupee. But how it does not cross the limit is the main challenge. How to make the rupee stronger? Now, when we study about monetary policy framework, it is composed of objectives. Objective you have studied again and again. I don't want to repeat. Price stability and growth. Okay. So Now I am teaching you channels of money transmission. Money transmission means how money reaches the public and what is the impact, like interrelationship. See, first of all, interest rate and savings investment channel. Okay. If government, if RBI, I mean to say, if RBI reduces interest rates, loans become expensive or cheap. Loans become cheap, so cost of loans go down. And when loans have become cheap, investments have increased because now people will take investment opportunities. So this is the interest rate channel. And if interest rate increases, loans are discouraged, but savings are encouraged. Why? जब interest rate बढ़ेगा, when interest rate rises, it does not only increase for loans, it also increases for investments. So if I keep money in the bank, my money is going to fetch me higher interest. And naturally, class, if my money is going to fetch me higher interest, good. It's overall good. I love that. Encourages savings, and so spending is falling. Spending reduces. Great, sir. Next, let's talk about the further channel. Class, next is your cash flow channel. What am I saying? Next is your cash flow channel. A very easy thing indeed, class. If lending rate is reduced, lending rate, that is the loan rate is reduced, the EMI that people have to pay, suppose you have taken a home loan, so your EMI will reduce. If your EMI is reduced, you have more purchasing power, so your consumption will increase. Here they are saying that you have more cash available with you. Here they are saying you will have more cash available with you, isn't it? But the fall in it, but fall in the interest rate on deposits reduces income, so some people spending will fall. So more cash, more spending. If people have more cash, people will spend more. If people have less cash, they will spend less. So we have used the interest rate and cash flow channels. Third one is what? Asset price and wealth channel. It's interesting. If interest rate falls, prices of house and shares increases. Then you establish an interrelationship class. Do you know why? Do you know why? How things change? It's interesting. I will tell you. Students, if interest rate falls, more people will take loans. If interest rate falls, more people will take loans. And if more people takes loans, let's talk about house only. The demand for house will increase. So if interest rate has reduced, the loans that people are taking will increase. And if loans that people are taking increases, the demand for house increases. Students, if demand for house increases, if demand for house increases, what happens, class? If demand for house increases, what happens? Many people are demanding house. So the price of house will, absolutely, the price of house will increase. Absolutely, the price of house will increase. Now, when people have, the price of houses have increased, so the people who have house, their asset value has increased. If their asset value has increased, the amount of wealth they are having has increased. If the wealth they are having has increased, they can mortgage more amount. If they can mortgage more amount, they will get more amount for their houses, so their spendings will also increase. So what is, this is the entire cycle that I've explained right now. You see, nobody thought how fall in interest rate moving through asset prices leads to more spendings. On the hindsight, it would look that there is no relation whatsoever. But a closer look will give a realistic picture, which we see right now. Okay, now class. Exchange rate channel. Exchange rate channel. Pay attention, everybody. Exchange rate channel. If interest rate falls, think carefully. If interest rate falls, capital outflow will happen. Why? Because people will take loans. People will take loans for investment. For investment. And people might invest outside also. Yes or no? So the demand for foreign currency might increase. That people are taking loan from India but investing in America. So demand for dollar has increased. So demand for rupee has diminished. Yes or no? So the rupee depreciates. When rupee depreciates, when rupee depreciates, price of Indian products become cheaper. You know why? Because price of Indian products is expressed in terms of what? Rupee. So when the value of rupee has gone down, exports have become cheaper. So India's exports increases and imports become expensive. Understood or not? I will explain it to you again. Students, interest rate has gone down. Okay. It means what? Loans have become expensive or cheaper. Loans have become cheaper. As a foreign investor, as a person who loves investing, what you will do? Your loans you will increase. This loan you will use for investment, not in the country, outside. You invest outside. You invest outside the country. Let's say you invest outside the country in USA. So to invest in USA, what do you need? Dollars? Because you invest in dollars. So for that dollar, the rupee that you had borrowed, you will convert it into dollars. In doing so, the rupee has depreciated and the dollar has appreciated. So rupee has become cheaper. So earlier, let's say $1 was 90 rupees. Now $1 is 100 rupees. Dollar has become expensive, rupee has become cheap. When rupee has become cheap, for the foreigners, Indian products look cheaper. So demand for Indian goods increases. Why? Because Indian goods are now cheaper because of cheaper rupee. When the demand for Indian goods increases, our exports increases. But on the hindsight, one thing has also happened. Dollar had become expensive. When dollar becomes expensive, what do you think the demand for foreign goods will be? It will be reducing because now foreign goods are rather more expensive to us. So class, how many transmission channels was I able to explain you? 4. A simple question that ICAI can frame is how many channels of money transmission are there? A very simple question ICAI can frame. How many channels of money transmission exist? So we remember 4. Another question could be, which of the following is not a channel of money transmission? So you remember what are the channels of money transmission. Naturally, you will be able to answer what are not the channels of money transmission. So what are the channels? Number 1 is interest rate and savings investment channel. One is interest rate and savings investment channel. Number 2 is cash flow channel, dear students. Cash flow channel, dear students. Third one is asset price and wealth channel. Asset price and wealth channel. Fourth one is what class? Exchange rate channel. Ultimately, exchange rate channel. Sir, understood, sir. Sir, understood, sir. Now, operating procedures. For tools of monetary policy, there are two procedures. Quantitative techniques, RBI uses two techniques to control money supply, quantitative and qualitative techniques. Qualitative techniques are also called selective credit control techniques. You know why? First of all, this was a PYQ. Qualitative techniques are also known what? Selective credit control techniques. Selective credit control techniques. Do you know why, class? Because qualitative techniques can be used not for all the sectors of the economy or not for all the businesses in an economy. They are sector specific. Now, quantitative techniques, I will explain first two today. CRR and SLR. What is CRR and SLR is what I am going to discuss today. Then we will wind up the discussion. See, first of all, both are decided by RBI and both are quantitative techniques. So don't ask any question from that part. Now, what is the difference? Students, CRR and SLR. CRR is cash reserve ratio. So it has to be maintained by commercial bank. SLR also has to be maintained by commercial bank. But wait, CRR can be maintained by commercial bank in the form of cash. They have to maintain it in the form of cash. On the other hand, SLR can be maintained by commercial bank in the form of cash, gold, or in just a fucking in the form of cash, gold, or any other approved securities of the government. Or any other approved securities of the government. Commercial bank, cash, commercial bank, they can maintain it in the form of cash, hold, and government approved security. Third point, CRR, suppose 1,000 rupees deposit commercial bank received. 20% is CRR. So CRR has to be deposited with RBI. Means commercial banks have to mandatorily deposit it with RBI. CRR, they have to mandatorily deposit with RBI. On the other hand, SLR may or may not deposit with RBI. May not deposit with RBI. I mean, commercial banks can keep it aside in their own lockers. It's not that they make this reserve and deposit it with RBI. They can keep it aside in their own lockers in a safe manner. They can do that. Class, am I able to explain this clearly? Is the entire picture getting clearer as we move ahead, everybody? Right, sir, it's getting clearer. Right, sir, it's getting clearer. Now, so to sum it up, CRR stands for cash reserve ratio. SLR stands for statutory liquidity requirement. CRR, who maintains commercial bank. SLR also who maintains commercial bank. But CRR has to be maintained in the form of cash. SLR, they can maintain in the form of cash, gold, or any other approved security of the government. One important discriminating factor is CRR has to be deposited with RBI compulsorily. SLR is optional. They can keep it aside with themselves. Now, both these tools I have told you, but what do RBI do? What does RBI do? Students, when there is an inflation, that is when money, why is inflation there? Because everybody has money. So there is more demand for the products. There is more demand for the products. So when there is inflation, RBI can increase the CRR and SLR. When RBI increases the CRR or SLR, commercial banks will have to maintain more deposits with RBI. So commercial banks will be giving lesser money to the public, because during inflation, you want money supply to reduce. And with this class, I wind up today. See you all in the next class. Goodbye, everyone. Thank you so much. Yes, yes.